Hello everybody, this is Mansoor Suhail from the Accounting and Tax. We are cross-border tax specialists based in Toronto, Ontario. Today we'll talk about some state tax issues. So, first thing is how to figure out if you need to file state taxes. Here is how to figure out if you need to file state taxes while living in another country. What you need to do is you need to determine if you are a tax resident of the state. And how do you do that? If you meet the following criteria while living overseas, you will most likely be deemed a state resident. You are a resident of the state at any time during the tax year. 2. While you are away at sea, your immediate family resides in the state. 3. Each time you return to the United States to live, you return to the state. You live in the state, which is a permanent place of your residence. In the state, you keep your driver's license, identification card, and voting privileges. Next, check to see if you have a source of income in the state. Work-related income is virtually always taxable in the state. If you live in the state, other income from a state source, such as pension, retirement income, or government benefits, may be taxable. The qualifications for residency vary by state, but most consider you a non-resident if you live outside the state for more than 6 months. So let's talk about income taxes in different states. In the United States, state governments impose their own income taxes. Non-residents are taxed in the state where they earn money. The rates are progressive and differ by state. The income tax brackets are essentially the same as or slightly modified versions of the federal tax brackets. 7 states, on the other hand, do not levy income taxes. These include Alaska, Florida, Nevada, South Dakota, Texas, Washington State, and Wyoming are among them. In New Hampshire, only interest and dividend income is taxed. But in Tennessee, only stock and bond income is taxed. Rental profits from USA. Non-residents with rental income are subject to federal and in most cases, state taxes. Rental income is considered investment income at the federal level, and non-residents can choose whether their rental income is categorized as fixed determinable annual periodical FDAP income or effectively connected income, short ECI. In general, ECI is considered when a non-resident engages in a trade or company in the United States. FDAP income is earned when a non-resident earns income from stable or regular sources, or when income is determinable before it is earned. Rental income is subject to a 30% withholding tax under the FDAP classification, which is charged on the gross amount, without regard to deductions, personal allowances, or credits. If the taxpayer elects to have rental income classed as ECI, standard progressive tax rates are applied after permissible deductions. Non-residents are only granted this option when it comes to real estate income. Thank you for listening. Folks, I invite you to visit our website www.theaccountingandtax.com, where you will find lots of valuable material on taxation. And if you have any question regarding cross-border taxation, feel free to give us a call at 416-283-8774.